Hello and welcome to Investing Confidential, Brazil version. The Fed is technically bankrupt. Okay, you heard it. The US government's a joke and Wall Street is a disgrace. Okay, I hope everyone's doing okay. I hope that scares you because this is the reality. I'm going to talk about things in reverse order that I mentioned, finishing with the Fed. But man, I'm doing this video because I'm really getting angry. Getting angry about what's going on with the government. I'm getting angry at the Fed. I'm getting angry at YouTube. I'm really angry at YouTube, but that's another story. All right, so let's start with Wall Street. I've already talked about the fake banking crisis in the last video. If you want to listen to my views on that, watch the last video. So I'm not going to get into it in too much detail. But this whole thing about the shadow banking industry exploding, this is real, folks. This is real, and it hurts you. It hurts business. It hurts everyone because borrowing costs are going up. Okay, there is already, and the mainstream papers are writing at it. But if you've been listening to me, I've been telling you, there's a credit crunch going on. So when banks are having problems, when their net interest margins, okay, their NIMs are shrinking because they got to pay higher on deposits, what do? And they're worried about people paying back. What do? They start restricting credit. Local banks especially, which are worried because of all this nonsense going on with even the fake banking crisis, they're pulling back their horns, and so there's a credit crunch. We're heading into a recession and there's a credit crunch. This is the worst case scenario. And so you got these shadow banks, hedge funds, private equity, VCs, and they're coming in and they're stepping in. We'll step up, but they're lending at 400 or 500 basis points higher. I mean, this is a disaster, an absolute disaster. And now you got the US government trying to play hardball with the debt ceiling. I mean, this is a joke. Both sides are morons. You got the White House. They want to keep printing money. They want to print trillions of dollars. They don't care. Okay, politicians believe now they don't have to raise taxes anymore. They can just print money. That's a new vehicle for them. Okay, and now you got Congress playing politics with the U.S. economy. But it's too late. The U.S. economy's gone. We're in recession, but let's use what the morons are saying. Recession is looming. Yeah, it is looming, and it's going to be real long. Okay, this is probably, they say we had a recession in 2020 with the pandemic. That wasn't a recession. That was just a blip. Okay, that recession was a few months. This recession is going to be years, folks. I'm telling you right now, because stagflation is here. When you have high inflation and negative GDP, that is stagflation, and I don't see it getting any better anytime soon. Powell is powerless. Okay, the guy is completely powerless, and now, as you can see here, his credibility is shot. Okay, it was actually high for a while. It's now shot. And by the way, he cares about his credibility. That's the only thing he cares about, his legacy. So what is he going to do? Is he going to stand his ground and keep rates at a high level, or is he going to give in to Wall Street and the politicos and signal he's going to cut rates? No one knows. But the interesting part is that the guy does care about his legacy. He really does. And if he does, in the short term, it'll be very bad because rates will stay high. But in the long term, it's very good because he will eventually hit the economy hard, unemployment will skyrocket, and inflation will subside. Not to the 2% level, but look, at 3.5% to 4% inflation, that's normal around the world. You got to have that. That's the only way businesses can thrive. Okay, and we need that. We need that. But in the short term, it's going to be very bad. Okay, because it's just going to be bad, and it's going to keep the recession longer, which is for the long term good. But in the short term, it's not good for this current White House, and they're going to do everything they can to shut this guy down. That means we're going to see more banking crises. We're going to see insurance. This is, by the way, fictitious. But okay, so let's talk about the Fed. I mean, I have said in a past video that the Fed is bankrupt, technically bankrupt, and it is. Okay, and it's very simple how it is. Since 2009, the Fed started doing something called QE. Okay, quantitative easing. What that meant basically was they were going into the bond markets and buying everything. They're buying mortgages, and what the ideologue about that is you buy the bonds and you drive the price of the bonds up and the yields lower. And the idea was to lower rates over a long period of time, and they succeeded. Okay, so the Fed bought a ton of bonds at high yield 2009, 2010, 2011, and as the rates went down, the Fed was just flush. Their balance sheet was massive. They were making tons of money. But as the rates started to really plummet from 2016 on, they just kept on buying when they didn't have to. Okay, the economy was holding its own during the Trump administration. It was okay. It wasn't great, but the stupid Fed kept buying, and they kept averaging at lower yields, to the point where we have the situation today where you've got the U.S. government with an average duration of less than 3 years, like 2.5 years, and the Fed has been buying bonds, everything they can, mortgages at 3%, 2%, whatever it is. And then rates spiked in 2022. And we saw what happened. UK pension fund bankrupt. Okay, all these banks, I told you, they're technically bankrupt, but there's plenty of liquidity, so there's no reason to worry. But here's the Fed. Imagine you're buying all these bonds at extremely low yields for 5 or 6 years, and all of a sudden rates more than double. You know, from 50, you were buying 50 basis points, 25 basis, and next thing you know, those same bonds are now 4%, and the bond prices have plummeted. So technically, the Fed is bankrupt. Now we know the Fed's really not bankrupt, but they're going to hold to maturity like they say they are. But man, it's really bad. Okay, so but here's why this is really important. It's all about the U.S. credit rating, and we're about to come into a crisis because you've got the debt ceiling and you've got what's going on today. So the United States has a credit rating of AAA, Fitch and Moody's, AA plus with Standard & Poor's. Okay, these are the highest possible ratings with the exception of Standard & Poor's. And it's important that the U.S. have these ratings because obviously they get a very good rate when they sell bonds into the market. The last time the U.S. debt was downgraded was in 2011 by Standard & Poor's, August 5th, by the way, was AAA to AA. Now, if you remember what happened August 5th to 11th, the markets got destroyed. It's the first time in history the U.S. government was downgraded. Okay? Now, flash forward, I think we saw this chart before. U.S. interest payments, because debt has exploded and they have to now refinance at much higher rates, we're almost at $1 trillion. And we're going to be at $1 trillion in, I don't know, less than 6 months. So if you assume, follow me here, if the U.S. interest payments on their debt was $1 trillion, this would be significant, okay? The government would have to borrow more to pay interest. You'd have the national debt increasing. This would lead to higher rates for businesses. So even a Fed rate cut's not going to help, okay? You're going to slow economic growth. I mean, it's a nightmare. It's basically financial. It shows the world that the U.S. is not financially stable or prudent. Okay, and you'd have investors like China continuing to sell. You'd have foreign governments demanding higher rates. Meaning, when they go to auction, they would demand higher rates because you've had a downgrade, and it's a major problem. Okay, and just look at the numbers. So, interest payments on debt, on $1 trillion worth of debt. This is a debt to revenue ratio of about 1.5. That means you would owe $1.50 for every dollar revenue you take in. I mean, if you had that in your personal situation, you'd probably declare bankruptcy. I mean, it's a nightmare. Okay? Then you look at debt payments, again, of $1 trillion. Interest payments to revenue, it's about 10%. Okay, I've done a recalculation, about 10%. You know what the average debt payment to around the world and in developed countries are? It's 4.5%. So we're in less than 6 months, the U.S. is going to be at 10% interest payments to revenue. The rest of the world is at 4.5%. There are some countries that have higher, Japan and Italy. Do we want to be Japan, which has had 30-year recession? Do you want to be Italy, which is one of the pigs? They used to call it the pigs. Okay, so we are, as they say, up its creek without a paddle here. And demo day's coming, okay? It's coming very soon. So there is a debt downgrade coming. I will bet money on that. Okay, and finally on YouTube. Guys, I'm done with YouTube. I really am. I'm going to stick it out for as long as I can, but I don't understand. I get great feedback from all of you, and my videos go nowhere. So, screw you, YouTube. I may go to another platform. Who the hell knows? Anyway, listen. Debt downgrade coming. Recession coming. Stagflation coming. The Fed's clueless. Wall Street's a bunch of thieves. The U.S. government's a disgrace. Okay? Have a great weekend. And investors, be really careful out there.